If you've never made money with your technical indicators on the chart, it's because trading is not about trying to predict the price action. I said today it was a bear market. It looks bearish, but it doesn't matter to me. I longed here and I shorted there and I made money. So the goal is to identify things that matter. And I took my journey to trying to figure out what does matter. What I found is that volume is really easy to predict. My first thing I tried to calculate and figure out was when I was reading the CME Group patents, I found out that they set margin requirements based on a program called SPAN. And what SPAN does is it looks for the distribution of liquidity and reportable futures positions on these big entities, like big firms that report long and short NASDAQ. As an easy to understand example, this isn't how it is, but let me explain it that's easy to understand. If everybody was like, I'm long NASDAQ here, this is one firm, another firm, another firm, another firm, and everybody's like, I'm long here, 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 and here, and here. There's other people that are like, I'm short here, 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 and here, and that's it. You've told them where the liquidity is. The sellers are here and the buyers are here. And because you told them, if anybody's gonna buy, it goes to the seller. If anybody's going to sell, it goes to the buyer. And if they're already there, then your expected range is the distance between these two. So what they do is that if that distance gets bigger, they would make the margin requirements slightly bigger to put less pressure on the boundaries to make the contract more expensive to trade. If the market was more liquid, i.e. these people were closer together and they were here and here, then the margin requirements would go down to make it more plentiful to trade. As liquidity went up, they would try to attract buyers in the contract. If liquidity went down, they would try to prevent people from buying the contract, make it more expensive to trade, fewer pressure on the market. To keep the market in check, it makes a lot of sense. If it's liquid, let's lower the price as much as we can because we make money on every trade that happens. So they're trying to make it as low as they can to bring in as much commission as they can per dollar without making it too cheap to buy the contract when there's no period of liquidity. SPAN runs 16 scenarios. I started doing the work on SPAN in 2015 and 2016. And I found out that what they do is those scenarios are looking for what happens if the market moves X%, Y%, Z% in other direction. What's the probability of a loss of portfolio? And they look at a lot of different scenarios and say, if the market moves this much, then everybody will lose 60% of their portfolio. If the market moves this much, they'll lose 40%. And they look for those like worst case scenarios and they margin the contract appropriately. And it's based on market moves and volatility and other things. So the idea was, what they did was they took the reportable positions, like where the liquidity is. Just imagine liquidity is where your sellers and buyers are. And then they run it through the scenario program and they come up with one number, the margin requirement. It's the minimum they set at clearing. Clearing firms must maintain that margin to allow you to trade the contract. We get these margin requirements that we always overlook. We thought, yeah, it's just a number, who cares? That $15,000 margin requirement literally tells you the range of liquidity. And when I discovered that, it was an eye-opening, mind-breaking thing. The market moves in discrete intervals. Futures market does based on that margin requirement. It's so crazy how it works. And I show it to people and it completely blows their mind.